In this video, I want to talk about something really important that I don't think a lot of people understand. And I want to kind of illustrate and make it as clear as possible exactly why bridging over to Ethereum is just going to naturally, through arbitrage flow and inventory management, create additional buying pressure on Zeph. And, I laid this out a little bit in a previous video. And that's where this hypothesis and reasoning comes from. So check out that video if you haven't. But what I want to do here is go into more detail, talk about additional information that's been released from the dev recently. I am just a Discord member. I am not part of the team. I have analyzed a lot of different information and I find it very interesting. I think that a lot of people, haven't put in the amount of research that I have with regards to how arbitrage works and what's going to happen. And if you kind of hear out my hypothesis and kind of look at the details, please let me know if you find anything that's inaccurate. I really am trying to get information out so that I can not only educate people, but I also want to be able to see if there's any flaws in my reasoning. So, of course, none of this is financial advice. I'm just trying to provide the details of what's going to happen when Zephyr is bridged to ETH. And so there are a lot of details, and it is pretty complicated. So why don't we just jump into some of this? Soon, DeFi users will have access to Wrapped ZYS using their favorite ERC20 trading platforms, Uniswap, PancakeSwap, SushiSwap, 1inch, DYDX, KuiperSwap. These are some of the most popular ones. You can purchase even in your MetaMask. And really, there's a lot of different places you'll be able to access ERC20 tokens, and that's really what this is about to become. Simply by purchasing Wrapped ZSD or Wrapped ZYS, these buyers will effectively cause bots and arbitragers to purchase Zeph and lock it in the Zephyr Reserve on the native protocol. Wrapped ZYS buyers will never need to touch the native Zephyr blockchain because bots and arbitragers will balance and fill ERC20 pools. So this is kind of the main argument that I'm making. So let's kind of get into some of the details. This is a flowchart that I have made after digging into Discord messages that are publicly released by the dev. And we'll actually go over that information together a little bit today. So I'm going to go over that in just a minute, but I want to lay out just a few things here before we jump in so that you're going to have more information when you process that infographic that I made. So the first thing you have to understand, which is a fact, is that Wrapped ZSD or ZSD, native ZSD, the only way for it to exist is Zeph essentially has to be in the reserve, right? And if it's in the reserve, it's not in the circulating supply, meaning it's not in the market. You can't go and buy it off the market. It's removed from the marketplace, from the circulating supply. You could think of it that way. Depends on, what words you want to use to describe this. And then it goes into the reserve. And like I said in the previous video that I made, the reserve is like a bank account. It's a pool that is part of the native blockchain. It's how it was built out. And that pool, you can go look on the website and see how much Zeph is actually inside of that pool. And that pool collateralizes ZSD. It's what backs and allows for the creation of ZSD. And so if you hold ZSD, then there are Zeph coins behind it, locked away somewhere. And it's not like it's locked forever. It can be moved out of that pool by whoever has control of it, which are ZRS holders or ZSD holders. If I have ZSD, I can swap back to Zeph so I can get it back out of that bank account. But you should just know, for the purposes of understanding what I want to illustrate here, ZSD is always connected to some Zeph that is in a bank account that is out of the circulating supply. And then that's also true for ZYS and ZRS. So ZYS is just ZSD staked in a ZYS reserve pool. And so that's really all it is, right? It's just ZSD in a pool, and that's where you get ZYS from. And of course, if there's ZSD in a pool somewhere, then ZEPH is also in the pool backing that ZSD. And then ZRS, very similarly, in order to get ZRS, you have to have ZEPH, which is removed from the circulating supply and placed in the ZRS reserve. And so in purchasing Wrapped ZYS, the buyer will effectively be locking ZEPH supply away, creating more supply shock, increasing the ZEPH price, sustaining the APY of Wrapped ZYS, allowing more to purchase ZYS, and so on and so forth. So essentially, if somebody wants to buy Wrapped ZYS on Uniswap, then they will be holding ZYS, which has ZEPH behind it in the bank account that is the Zephyr Reserve. And you can see how many ZEPH are in that reserve right now. There's almost 3 million ZEPH in that bank account. And so it's backing ZSD, and when ZSD is put in a pool, it mints and creates ZYS. And so in order for someone on Ethereum to get Wrapped ZYS, that means there is an equivalent native ZYS that has native ZSD backing that, which has native ZEPH backing that, which is locked away and not for sale. And so if the price of ZEPH goes higher, the block emissions is higher. And when the block emissions is higher, because the yield comes from block emissions, the yield is higher. And if the yield goes higher, then more people can go into the pool. And when more people go into the pool, the ZYS pool, or when more people own ZYS, that's just another way of saying it, then they can still have good, appealing APY. And the reason for that is if I buy ZYS, I actually will have a share of the yield. And when more people enter the pool, then my share of the yield will go down, and so the APY will go down. However, with ZEPH, it's uniquely different because in order for those other people to enter the pool, they actually have to buy ZEPH, which will push the market cap higher, and it will push the APY higher. And so that when they do enter the pool, it balances itself out. It's like a gyroscope. The whole protocol, the whole JED protocol is a gyroscope. It is self-balancing. It will even itself out over time so that the APY will settle probably somewhere around 30 to 50% as people enter the pool. Then that will be sustained because they will be pushing the market cap of ZEPH higher. Okay, so this is a Discord message from the dev team. And I just want to kind of read through this. It will be helpful in kind of outlining some of the main features of the liquidity management and arbitrage flow that I was talking about. It will help to really further your understanding of the infographic that I'm going to go through. And, of course, this is on the Discord. You can go check it out. This was posted on October 21st, 2025. Dev says, I've been working away over the last couple of weeks on the bot suite for the bridge, liquidity management, arbitraging, etc. It's actually pretty involved. It's a whole project in and of itself and a bit more than the small section of the proposal that mention it implies. But it is very cool. Going through this also brings to light some ideal QOL features for the bridge itself, which I'm excited to implement too. It's always good to see when the dev is excited versus fatigued or burnt out. So, there's obviously a lot of work ahead of him, and being excited, goes a long way to getting that work done in a timely manner. And, that's just great to see. The whole goal of this is to keep the LP markets tight and with good liquidity and accurate prices. It's not about making profit from the arbitrage itself, although that path will be open for anyone who would want to do that. So, the main points here are that the liquidity management is to keep the markets tight and with good liquidity, and the arbitrage is to keep the markets tight, right? This is kind of the same thing, or they're very similar. And of course, anybody can do arbitrage and make money off of that. We'll talk about that a little bit later in this video. This matters because this is the abstraction layer engine that actually interacts with the Zephyr network behind the scenes at fills and fills demands. So, you can really think of Zephyr Protocol as an engine. It's like a heartbeat. It's like a gyroscope. You can kind of think about it in those ways. It has momentum, and the momentum comes from the proof of work block emissions. And those emissions are fueling this engine. And then the way that the code base works is such that it is self-balancing, where ZSD and ZRS and ZEPH and ZYS, they all will kind of have a dynamic influence on each other. And it's like a gyroscope in the sense that they self-balance. And that also is kind of what I talked about in my previous video about how ZSD works and how it will keep that peg because of the way that ZRS works. And, that's very self-balancing in a way. Dev says, for example, a user swaps USDT for Wrapped ZYS, increasing the demand for Wrapped ZYS. How do we fill that demand? In essence, we take the USDT, we buy ZEPH, we convert that to ZSD, convert that to ZYS, and bridge to Wrapped ZYS. In practice, it works a little differently than this. There is inventory management, liquidity management, and so on. And the stable rail into our pool is Wrapped ZSD USDT. So we'll come back to this in just a moment, but basically it's not as simple as this. But that's a good way for you to understand exactly what my argument is. If somebody wants Wrapped ZYS because it is going to have really good APY, then in order for them to get that, they will naturally, through bots, cause the system to purchase ZEPH to back more liquidity so that when the next person wants to come in and buy more of this, there is more available. And since there's more available, that means there's more ZEPH locked away somewhere in order for that to happen. So there is this buy pressure that's taking place. But we're going to get into the details of how that works so you can really understand why, if there's any amount of buy pressure on Wrapped ZYS when it's bridged to Ethereum, then the ZEPH market cap is simply going to go higher. And in my opinion, it's going to go a lot higher than what it currently is at. So, we'll get into those details. First, I really just want to point out that, again, on the Discord, this is publicly accessible. There are screenshots that the dev has released. And this is quite interesting. You can see the asset ZSD versus Wrapped ZSD. And then, of course, the decentralized price is the same as the reference price. But in the case of ZEPH and Wrapped ZEPH, you can see there's actually a discount. And so one of them is not priced the same. And so then there's an action that can take place, and it gets triggered when a certain amount of price deviation takes place. And then this monitor will actually execute that plan. And again, another screenshot showing, well, if that is getting executed, how is it going to do it? And then this is kind of the way that it would go about processing that route. And so that's on the Discord. You can take a look at this information. It's very interesting. But yeah, basically the dev has released more information about how he is building out these bots and automated systems that will provide inventory and liquidity. We'll talk a little bit more about exactly how that works in my infographic, but these details are relatively new. And so I just wanted to kind of cover these and help you to understand exactly kind of what you should expect when this is all bridged over to Ethereum. And we have the ERC20 tokens. And then this is a screenshot of the testnet. So you can go to the website and then you can go to the testnet. You can enter the testnet app and you can take a look at all of the details about how ERC20 tokens are actually around the corner. You can see that if I want to get ZSD, then I can go ahead and swap my USDT to Wrapped ZSD, and that is a pair. It's a pool. These two are paired together. And then if I want to get ZEPH, then I have to actually go to ZSD and then swap that ZSD to ZEPH. So that's really the route. That's because USDT is not in a pool with Wrapped ZEPH. It's only in a pool with Wrapped ZSD, and then Wrapped ZSD is in a pool with Wrapped ZEPH. So you're just kind of taking these hops in order to get there. And that's important because when it comes to ZYS, which is really the main point of this video, when anybody wants to get ZYS, they actually have to move into the ZSD pool first, and then from that pool into Wrapped ZYS. And so this brings us to my infographic. So let's go ahead and take a look at that, and all of this will make a lot more sense. Okay, so this is my arbitrage bot flow infographic. When the decentralized exchange price is not aligned with the centralized price, this is the bot flow that takes place. It begins when there is a price difference between either the native wallet, the centralized exchange, or the decentralized exchange price, which will trigger the bot and send inventory to balance the pool immediately, and then begins the process of buying Zeph off of the centralized exchange to replenish the inventory. So if I want to buy Wrapped ZYS and I have USDT, I could use my MetaMask and I could connect it to Uniswap, and I could go ahead and just swap my USDT to Wrapped ZYS. But because the liquidity pairs are such that it has to move through ZSD, this is the process by which it would work. And if there's enough people buying Wrapped ZYS, then what happens is there is an imbalance in the pool where there is more USDT than Wrapped ZSD. And as that ZSD is then swapped for Wrapped ZYS so that the individual can get that Wrapped ZYS, then there is more ZSD in this pool, in this pair. And so that has to balance somehow. So if there's $6 worth of USDT here and $4 worth of ZSD, then $1 can be used to buy Zeph off of the centralized exchange. This creates buying pressure. And more importantly, it takes Zeph off of the market and it adds it to the protocol reserve, which is like a bank account, and it removes it from the market so nobody can buy it, which again, a big part of my argument is if it's being locked away, that will further increase price discovery to the upside. And so you really kind of want to keep that in mind when we think about this whole process. And so as that Zeph is in the reserved, it's then swapped to ZSD, and then that's wrapped into an ERC20 token. And then that ZSD can be added to this pool here so that that $4 can then turn into $5, and then you have $5 on both sides, and then that is balanced. And so liquidity management and inventory management, what the dev is saying is there needs to be an inventory ready to manage the pool liquidity so that these are always balanced, which allows for less slippage. And of course, that's really important for the buyer. They don't want to have tons of slippage. They want to be able to get in and get out. And so that's why the inventory is necessary. It allows for the liquidity to be such that it's balanced. And in order to balance that liquidity, there needs to be buying pressure, because if there's ZSD or ZYS that needs to get added, which happens from the inventory, then there is Zeph behind it. And so if there's more ZSD being added to these pools in order to maintain the liquidity, then that means there's more Zeph being purchased and being locked away and being swapped into ZYS and ZSD so that they can be added to these pools. And so if people continue to buy Wrapped ZYS, they essentially will be driving the Zeph price higher, because in order to manage the liquidity in these pools, it will actually drive the Zeph price higher, and that's really just how it works. The cool thing about this infographic is that it doesn't illustrate at all what will happen when other people want to arbitrage, because in the case of liquidity management, you're keeping this $5 and this $5. You're balancing it. You're not adding more liquidity. You're taking some of the liquidity and converting it, purchasing Zeph off the market, and then putting it back into the pair, but as the opposite side of that pair. In this case, it's Wrapped ZSD or Wrapped ZYS, and then you just balance it back out. So you're not really growing the total liquidity, except of course there are some fees and things like that. But really, when it comes to other people who might want to arbitrage, they can use bots to actually increase the liquidity. And so later in this video, I'm going to quickly talk about how that works. So kind of stay tuned for that. In this section of the video, what I want to do is explain why I think a lot of liquidity is going to be moving into Wrapped ZYS. Essentially, people will want to buy ZYS, and the reason they'll want to buy it is because it has the best sustainable APY on a stablecoin in all of DeFi. Right now, it's 32%. It's 29% on average over the last 3 months. And in its first year, it did 68%. So it has staying power. And one of the arguments could be, well, there's not a lot of people in the ZYS pool yet, so that's why the APY is so high. And I would say, well, actually, as people join the pool, they have to push the market cap higher, and that will actually increase the APY and sustain the ability for people to enter the pool, because the yield, the source of yield, is different than any other type of yield generating stablecoin. And so really, if somebody makes that argument, they just don't understand how Zephyr works. If you look at the landscape, This is Pendle.Fi, and the stablecoin top fixed APY. It's 23% for 365 days, but it's only 40 days, so you'll only get a small fraction of the actual percentage. So you have to be very careful of how you understand these things. Like this one is 82 days, so you'll get not even 10%, from that. And so there are some other caveats you need to know as well. Like if I want to get into this pool, I might have to buy SAT USDT plus somewhere, but it's more than $1. Like this is a stable coin, but because there's demand, the value of that stable coin has gone above $1. Maybe it's $1.03, and so I'll lose a little bit on that end. And yeah, there's a lot of things you have to keep in mind because the yield from these doesn't come from block emissions like ZEPH. It comes from these other sources, and so it's a little bit more tricky to understand. And one thing that's worth noting is when Zeph is wrapped as an ERC token, it actually can be then added to Pendle.Fi, and the APY can become fixed, and then the yield token can be separated out, and then you can sell the yield separately. It's actually a really interesting process. I think I'll make a whole video on how Zeph could be added to Pendle.Fi in the future. And if it's added to Pendle.Fi, it will be at the top of the stablecoin charts pretty much all the time, and it will be marketed to people, and then people will understand, hey, this is something I might want to get, and then they'll buy it, which will push the market cap higher, right? So as soon as ERC20 ZYS exists, it's going to be made more public. People will understand that this has staying power. They will then purchase it, which will increase the Zeph market cap, and the APY will be sustainable. I've said this a lot of times, but I'm really just trying to hit this message home, is that Zeph market cap is going higher. As soon as it goes to Ethereum, it's going higher. And that's because people will want to get access to the APY, and it will then kind of explode in terms of the mind share. As soon as Wrapped ZYS is on Pendle.Fi, it's pretty much over. The market cap will already be $1 billion or something like that, because you do have to build out a little bit of code in order to add it to Pendle.Fi. You can't just immediately add it. You need to create a code base that will split off the yield, and there's a specific way that the dev team will actually have to do that probably. But if it's on Fluid or if it's on any of these other protocols like Albridge, we'll talk about that in a minute, then the yield will be marketed to other people, and then they'll be interested in purchasing it. More people will talk about it, more people will purchase it. The total value locked in the Zephyr Reserve will go higher and higher, which will mean that there'll be less circulating supply, and the demand will go higher for that as a result of the trust that's being built. So you can check out my other video. I actually talk at length about this, so I don't want to go into more detail than I've already said. Check out that video if you want to learn more about exactly how Wrapped ZYS will kind of revolutionize the future of yield on Ethereum. So just really quickly, I should have talked about this earlier, but when you have a liquidity pool like we saw on my infographic with USDT and Wrapped ZSD, you basically have two tokens that are inside of a pool, and some liquidity provider has provided those, and they get a token that says, hey, I provided those, and then they get some swap fees and some other things. And then a trader can come in and they can send their USDT in, and then they can get some ETH out, and they pay a little bit of fee. And then when they do that, USDT gets bigger and bigger and bigger. If everybody wants ETH, then the ETH gets smaller and smaller. And so this is another way to visualize that. So a liquidity provider will input token A and token B, and then in return, they'll get the LP token or the pool token, which basically says, hey, I've added these tokens and I get some of the fees. And then those tokens go into the pool. And then if you have more token A, then you'll have less token B. And then if you have more token B, you'll have less token A. And you always want to keep them in a small range where there's more liquidity and less slippage. And that's somewhere in this range. And so this is just like a different visual mathematical graph way of understanding exactly how the liquidity works. So if more people start adding token B in, then there's going to be less token A. And if people add more of token A, then they're taking out token B in order to do that, and then there'll be less token B, and then this will eventually get lower and lower, and it will never go to zero. There's just be like smaller and infinitely smaller, and the price of the other token will get infinitely higher. And so because that is basically what slippage is, then in order to reduce slippage and to improve the liquidity, you have to have liquidity management. And the way that the Zeph team is doing that is by having inventory that's going to get filled from the bridge that is going to be swapping from Zeph off of the centralized exchanges, which is going to be purchased by the excess USDT that's inside of that pool. And then that inventory is filled, and then the liquidity is managed and the slippage is reduced. And through that process, Zeph is going to increase in demand. And so there are actually different ways that you can manage liquidity. You have this curve, you have bid ask, you have single-sided liquidity, and then you have this spot liquidity. I don't know too much about this, but there are benefits. There are pros and cons to different techniques. I think this is probably the most common one, but again, I don't really know exactly all the ins and outs of how to manage the liquidity inside of these pools. The last thing I want to talk about is how arbitrage bots work generally, and then apply that general knowledge to how arbitrage will work in terms of Zeph. So normally, if the price on a centralized exchange is different than the price on a decentralized exchange, a bot can recognize the difference, and they can very quickly purchase that BTC and then bridge it over and sell it. And when they sell for profit, they balance the price differences and they add BTC to the decentralized pool. So they're actually increasing the liquidity in this pool, so it's getting more liquidity. It's not just balancing it, it's adding additional liquidity. But in doing that, you actually push the price down because you're selling it here, and you push the price up here because you're buying it. And if the prices are different in the opposite direction, then you just go the opposite way. And that's how arbitrage works. The point that I want to make here is that through arbitrage, you actually take liquidity from the centralized exchange and you increase it over to the DEX. And when you ever increase liquidity, you do help with liquidity management, because if there's more liquidity, there's less slippage. And so that's actually very helpful. ChatGPT here is really helping you understand. You have Wrapped BTC on Ethereum, and then you have BTC on Binance. On Binance, it's a little bit more expensive, so that when you go ahead and buy the wrapped version for cheaper on Uniswap and send it over to the centralized platform, then you can, of course, redeem it one-to-one, and then you sell it for a little bit more and you take the difference. And that demand for wrapped BTC raises its DEX price until it matches the centralized price. If the reverse happens, arbitrageurs mint new wrapped BTC by depositing BTC with custodians like BitGo. They then will sell the wrapped BTC on DEXs, pushing the price back down. So of course there is a bridge. So this is kind of outlining some of the different features when it comes to, well, how do you have arbitrage work? You have to have bridges, and then you also have to have oracles. And then, of course, you've got centralized exchanges and decentralized exchanges where you have order books and AMM pools, respectively. And then you have market makers who keep those order books and traders. And then you have arbitrage bots that keep these AMM pools. And you have cross-exchange traders and so on. For the last part of this video, I want to show you how ZYS is actually not a new phenomenon, because I think a lot of people are curious about how is there a coin that only goes up. This has never gone down in price. You can see my other videos. I do talk a lot about this, but ZYS is not the first thing to ever do that. There's something called Savings DAI, SDAI. It comes from MakerDAO, and essentially it's DAI, which is a stable coin that is minted from collateral. So the way that MakerDAO works is that you can take ETH or BTC and you can then stake it into their protocol, and they'll give you DAI in return. And in order for that stablecoin to exist, it's being backed by a collateral, which is BTC or ETH or other cryptocurrencies. But if those cryptocurrencies go down in value, then that protocol, the way it works is it actually liquidates BTC or Ethereum and sells them. And then it takes the value of that and it backs the USDT. So you can get liquidated if you do this process. So it's a little bit risky to do. And actually MakerDAO has changed and rebranded to something called Sky Money. And they actually don't even have DAI anymore. They've transitioned that out to something called USDS. And for the savings USDS, it's called SUSDS. And so again, same thing. It started back in January 2025. It's gone up 7% since that period. It's a savings account where you accrue more value on your stable dollars. And it's the same thing as SDAI, where again, this started back in January of 2024, and it went up 21% over that period of time, which is almost 2 years. If you look at ZYS, it's the same thing, but it started in October 2024 and already went up 68. It actually has gone up 70% over that period of time, which blows both of these out of the water. And so that's why I'm so bullish on Zeph, is because it's not like ZYS is a new invention on its own. This is something that's already existed, but it's better than the things that already exist. And I'll just point out that USDS is actually decentralized just like ZSD. So that's very cool. You can see here, USDS is a stablecoin of the decentralized Sky protocol, which was previously MakerDAO, and the upgrade of DAI. It is backed by a surplus of collateral, also called over-collateralized, and soft pegged to the value of the US dollar, meaning it is designed to maintain a value equal to or close to a dollar. SUSDS is a savings token for eligible Sky protocol users. When you supply USDS to the Sky savings rate module of the protocol, you access the Sky savings rate and receive SUSDS tokens. These SUSDS tokens serve as a digital record of your USDS interaction with the Sky savings rate module and any value accrued to your position. The Sky protocol dynamically adds USDS tokens to the pool every few seconds in accordance with the Sky savings rate percentage. As those tokens auto-accumulate in the pool over time, the value of the SUSDS you hold may gradually increase. The Sky savings rate percentage is variable, determined by Sky ecosystem governments through a process of decentralized on-chain voting. Therefore, when you choose to redeem your SUSDS for USDS, which you can do anytime, the total USDS you will receive will equal the amount you originally supplied plus any additional USDS accumulated. The conversion rate between USDS and SUSDS is determined programmatically by smart contracts, but the dollar value should match given that there are no fees involved. When redeeming SUSDS for USDS, one would expect an increase in net USDS tokens in accordance with the Sky savings rate multiplied by the duration. So basically, the longer you hold it, the more USDS you'll get. So basically, SUSDS is exactly the same thing as ZYS. It's when you take your ZSD and you add it to the protocol, you will then in return get ZYS tokens or coins, and those will be serving as a record for the ZSD that you have in the protocol that is the ZYS Reserve that is getting yield from block emissions, and that will accrue over time as you hold that, because every 2 minutes it's getting more block emissions. You can use the Sky.money web app, a non-custodial gateway to the decentralized Sky protocol, to trade USDC, USDT, ETH, or Sky for USDS, or vice versa. You can also upgrade your DAI to USDS. So basically, you can go ahead and collateralize these things or add them to the protocol and get USDS in return. You can even add some volatile assets that can be liquidated if they drop too much in price, and then you keep your USDS, but you won't be able to get your ETH back. It gets sold. That's really how that protocol works. The source of yield for SUSDS actually comes from fees and interest and from other mechanisms which are decided by the government. But in the case of Zeph, those sources of yield are coming from block emissions. And then when it's wrapped as an ERC20 token, it can actually gain additional sources of yield, such as fees and interest and all of the other sources. So really, it's going to have a huge edge over things like USDS and DAI. Okay, so I just wanted to quickly point out the new MakerDAO website here is using something called Spark, and you can add BTC. Here it's called TBTC, which is a type of ecosystem where you can go ahead and wrap your BTC onto here, and then you can go ahead and you can get some USDS. And then there's this collateral ratio. You can kind of slide this up and down, and it will determine how much USDS you can get, and it also determines at what point you would be liquidated. If you don't know anything really about this, It's the loan to value kind of calculation. You should, take a look at that. But the borrowing rate, again, that's where the fees come from. So somebody who wants USDS, they have to pay 5%. And then somebody who wants to stake their USDS and get SUSDS in return, 5%. Or they're getting less, actually, probably. It's like 4% or something like that. So it's really not that much. ZEPH is like 32% right now. It's 29% over the last 3 months. And so really, a decentralized stablecoin that's getting yield is not nearly as competitive with ZEPH. And then, ZEPH obviously also can become private when you move back to the native wallet. And then also you could add ZSD to Allbridge. And when you do that, you get additional fees from swapping between different chains. Allbridge is really just swapping USDC from Arbitrage to Ethereum and so on and so forth. But so basically, you just get to provide liquidity and you get liquidity fees. And so that can further increase the APY. And you can see it's only 12% here. So again, the APY on ZYS is the best in all of the DeFi ecosystem. And, I talked about this in my previous video, but ZYS is coming from every single block, and the value of ZSD that gets added into the ZYS pool, which then is split amongst the ZYS holders. It comes from the price of ZEPH, and as people want to get into ZYS, they have to buy ZSD. In order to buy ZSD, they need to buy ZEPH, essentially. And in doing that, that pushes the price higher. And then the block emissions has more value, so that more value goes into the pool and it sustains. That's in a previous video. You can go ahead and look at that. Okay, so the last thing I just want to end on, again, Wrapped ZYS has a cap downside. ZYS only goes up. Same thing with SUSDS, it only goes up. Same thing with SDAI, it only goes up. Those trains, they don't stop, they only slow down or speed up. In the case of SUSDS, it's up 7% in a year. And so it's only really 7%. This, you can see, it is up more than 64% in a year. So it is much better than the competitors. And because it has a cap downside and it can only go up, then what you will find is through arbitrage, this will be such that you will ultimately be pushing the price of ZEPH higher, which will only make ZYS even more appealing, which will make Wrapped ZYS appealing, of course, because it's a lot easier to get. Okay, so hopefully this video made sense to you. If you have any questions, feel free to leave them down below. I'll try my best to answer those. And, I'm always open to dialogue about this. It is kind of difficult, but once you understand how the dev team is providing liquidity management and arbitrage, and how other people can provide arbitrage, which would add liquidity and decrease slippage and further build trust and allow other people to move into Wrapped ZYS, all of these processes will ultimately cause buy pressure on ZEPH, and that will sustain people moving into ZYS. And then you really kind of get this flywheel effect. And, ZEPH is like a beating heart. It is like an engine, and this engine is very young. It's only 2 years old. It's just getting started. As soon as it moves over to Ethereum, ZYS is very likely going to pull in a lot of liquidity, which will naturally push the market cap of ZEPH higher. And so maybe before the bridge is launched, you might want to get a little bit of ZEPH if you think that that's the case. But anything could happen, so who knows what will ultimately happen, but this is kind of my hypothesis. And so if you like this video, give me a thumbs up. If you want to see more videos like this, subscribe, and I'll see you in the next video.